what we're going to do today is in this session is we're just going to go through real briefly 10 slides, talk a little bit about service centers, basic concepts, things like that. And then we're going to try to spend more time with question and answers. We have two of our campus colleagues here who are going to be able to talk a little bit about maybe some of the challenges and some of the issues from a campus perspective. But we really didn't want to have this be like a PowerPoint presentation. We want to just do as much question and answer and real life, what do I do in this situation session. So with that, I'll just introduce our esteemed panelists here. So to my right is Chris Rafalik, Senior Cost Accountant at the RF Central Office. Dave Martin, Campus Services Manager at the RF Central Office. Don Arts, who is Senior Administrative Associate of Post Award at ESF. Did I get that right now? Close enough. And Sheila Ruth, Director of the Office of Grants Management at Stony Brook University. We also had Mark Mariglia from UB was scheduled to be with us, but he had an emergency at home, so he wasn't able to make it. So I do have some notes from Mark. We may be able to talk a little bit to some of Mark's issues and challenges. So I guess without further ado, we'll just go ahead and go through the slides. And please, if you have a question and you want to ask it at the time, feel free. Or if you'd like to wait, either way works. Let me get a little bit out of the way here. So for the most part, service centers in definition are relatively simple. So one of the definitions is a department or functional unit which performs specific technical or administrative services primarily for the benefit of other units within a reporting unit. So it includes recharge centers and specialized service facilities. So it's really a service that's being done on the campus where you charge a fee primarily to another internal user. The uniform guidance and previously in A21 really never addressed service centers. They addressed a type of service center called the specialized service facility, and it's defined as highly complex or specialized facilities such as computing facilities, wind tunnels, reactors, that kind of thing. So it's not like you just open up the uniform guidance or you open up the federal regs and see how do you treat service centers. There is a lot of information out there, but it's not a really well-defined thing at least within the uniform guidance. So within the uniform guidance, as I just mentioned, there is one section, it's the specialized service facility that they address, but a lot of the principles still apply to many of the other things we do. So a couple key things that we want to remember with service centers is number one, you really should be just charging costs. So especially on a federal award, you really cannot charge any more than cost. So that's kind of a key principle. And then the other principle is you need to charge based on usage, right? So if somebody is coming in and they're using, they use 4 lab tests or they're using an animal care facility, they get charged on usage. So, not rocket science, relatively straightforward, type of regulations. There really should be, best practice would be to have some kind of published rate schedule. So if you're charging, $500 a lab test, it should be known that that's what the charge is, because a lot of times you put a charge through to a grant, the paperwork goes to, the sponsor programs office or to the AP office, and how do they know $500 is the right rate? So it's just kind of some of that. And the other thing I mentioned is with the real concern with service centers is on charging federal programs. Not that charging state programs or charging private sponsors, is not a concern. But, a key principle is that rates don't discriminate between federal and non-federal users. So oftentimes we'll get questions about, well, that means I have to charge everybody the exact rate. Doesn't necessarily mean you have to charge everybody the exact same rate. You can give a discount to an internal user, but then it comes around to, okay, but then the next time you develop the rate, because you gave a break to an internal user, you can't then give that break, you can't then charge the federal government more the next time around. And we'll talk a little bit about that, but for the most part, it basically means the federal government does not want to get charged more than it costs. So the other key concept is rates must be equal over time. They must be adjusted at least biannually. So every 2 years you need to adjust the rate. And it needs to take, the rate adjustment needs to take into account any over or under recovery from previous periods. So if you were, charging $100 a test, and then at the end of 2 years or at the end of a year, you have a pretty large surplus, you then need to lower that rate to say, okay, I shouldn't have been charging $100 a test, I maybe should be charging $90 a test. So that's what that means. So a little bit about the service center policy. So about, I guess a year or two ago, we actually changed the RF procedure. It used to be a guideline, it's now a policy, so we kind of made it a little bit higher level requirement. And we updated our procedures, and we have updated some practice documents. As I talked about before, the specialized service facilities are a type of service center. Basically, if it's $1 million or more in direct operating costs, it's highly complex. And the other kicker here is that if it's material charges to federal awards, and material charges to federal awards is deemed to be $250,000. So as far as the monitoring process is concerned, and this, similar to what Justine Gordon just said at the last session, be aware of where it says must and where it says should. So, must is, you need to follow it. Should is really a best practice. You don't have to follow it, but it's kind of a good idea, or maybe there should be some compensating control. So, one of the challenges that we have here is that oftentimes a lot of the service centers, a lot of the activity that we're talking about is on the SUNY side of the house. Sometimes we don't have a lot of control over what's going on the SUNY side of the house. But from a federal government standpoint, they basically consider us to be one institution. So if we have a large service center that's on the SUNY side of the house at your campus that's charging grants, right, these principles still apply. So it doesn't mean, on the RF side of the house, we have what we call service and facility accounts. But just so you're aware, it's the total campus that we need to be concerned about. A best practice is to maintain a listing of service centers, right? There are occasions where the feds will come in, whether it's with indirect cost or another audit that they might doing, and they'll say, all right, show us a list of your service centers. So it's good to have a list at your campus of, here's the service centers at my campus that we're recharging. Talked about billing rates should be reviewed every 2 years. And we need to have written procedures covering service centers, and we need to make sure that they're related to how they're established, communicated, and implemented. I'm sorry, I keep my back to the camera and my back to you people over here. And then central office performs additional monitoring, and Dave is going to talk a little bit about that. I went too far. Did I skip a slide?
You took half of my presentation.
I just talked about the. I'm like, why isn't Dave? Which slide did I miss? I hit them all?
Yeah, I got one more, the best practices.
All right.
That's okay.
Sorry, I'll turn it over to Dave. I just did one of his slides.
I'm the group here.
So Chris was talking about the central office monitoring that we do from here. So twice a year we send campuses a listing of all your service center balances as well as your recharge award balances. We do it at the end of the first quarter of the year and at the end of the third quarter. So the end of the third quarter, March 31st, we're going to be sending out reports here first week of April. And we follow up the Q3 reports with a call with the campuses just to discuss what's going on with your service centers, to get an understanding of your monitoring process, any issues, concerns that we should be aware of. We focus on large surplus or deficit balances that you have on your service center accounts, just to make sure that there's a plan in place, that the rates are being looked at and adjusted accordingly. We also, from time to time, we send out a survey, SNF survey for your campus to fill out, just so that we can get a better understanding of what kind of monitoring controls you have at your campus. Chris talked about some of the things, making sure that an independent office is reviewing your rates at least once every 2 years, as well as before a service center is established, that it goes through the proper reviews and protocols. Some of the other things that just making sure that your rates, when they're reviewed, that they're properly scrubbed for an allowable cost, things like that. Some campus best practices. Chris talked about the campuses should have campus-specific procedures. Mark's not here, but UB has really good campus policies around their service centers, which other campuses have used kind of as a template, as a starting point. There should be regular training conducted on your campus for all of the service centers. Campuses should have a person or group of people responsible for approving the rates and ensuring the existing rates are reviewed and approved and updated at least every 2 years, as we talked about. Also, if possible, costs and revenue should be recorded on the same account, whether it be on the SUNY side or the RF side. We have seen a lot of campuses have a service center, and they have activity on the RF side and the SUNY side, which makes it difficult sometimes to get the true account surplus or deficit of the service center. So it makes life a lot easier if all the activity flows through one account, whether it be on the RF side or the SUNY side of the house. And Chris also reiterated to reiterate that there should be a maintained published price lists of all the rates that are being charged, and there also should be an inventory of service centers. And the inventory of service centers, that should be shared with your campus CFO or VP for finance, so they should be aware of the service centers that are operating at your campus, because there's a financial aspect to these service centers. Most of these are being subsidized heavily at your campus, so your financial management should be aware of what's out there. So some common compliance issues that we've seen, because this is an area that the feds have really scrutinized over the last couple of years. And some of the things that they've found is inadequate policy or oversight at the campuses. Sometimes the billing rates are not based on actual costs. Projections are being used. Unallowable costs are being included in the billing rates. There's not a proper scrub of the rates when they're developed. Surpluses are not being carried forward, and the rates are not being adjusted accordingly to account for those surpluses. Invoicing not being done on a timely basis. Pre-billing of charging, this is a big one. You can't pre-charge your goods or services being charged at your service centers to an award. You have to wait until the goods or services have been delivered to bill. And finally, surpluses being used for unrelated activities. So you can't use your service center to subsidize other activities at your campus. Any surpluses have to stay within that service center and the rates should be adjusted accordingly for future rates. Any questions on campus best practices, compliance issues before we move on?
Sure. We have a brand new service center that was just set up, and the staff that own that center are 100% RF employees. So as it stands right now, their service account has a $0 balance because they haven't performed any business yet. How can we have them start doing work on that, but still having to charge their effort to RF accounts in the meantime? In other words, they don't have a budget in their service and facility account to actively charge effort to.
So you'd have to use projections, right, to establish the rate? Is that what you're asking, whether you don't have actual costs to base the rate on? Is that the question?
We have no
actual
cash in
cost.
yet.
Yeah, we
Okay,
have-
so when you're starting up a service center, you can operate in a deficit,
You
to
should,
start out, yes.
You should.
be.
Yeah,
Because-
and then you adjust the rate accordingly as you start billing the goods or services, it should break even over time. What we see at most campuses, though, your service centers don't break even, so your campus ends up heavily subsidizing the cost, and you end up writing off things from time to time. But in a perfect world, your service center should break even.
So at Stony Brook, we set all our accounts up at 0 because you have to perform services before you can charge for it. So there's always a deficit, and if you're doing things right, you'll eventually, if the swing were to happen properly, you'll break even. But at any given time, technically, you should have more expenses than you have recovery because you have to perform the service before you can get paid for it. I'll have directors, we're lucky because we have the same rules for both IFRs and service and facility accounts. We have one office providing the oversight of the rates. They verify that the costs are being charged where, they said they are. But at any given time, they'll say to me, well, I need to, buy something, or I need to hire somebody, and I'm in the process of changing my rate. And I'm like, they need to be there because ultimately when you charge back, the proof is that here were the costs. So it's a mindset that's hard on the RF side, but because you see a negative account. But we set those up for 0. I set those accounts up for 0, like a 0 budget, so there's always a debit and a credit. It's,
And another common issue we see, it's not really an issue, but we'll see service centers that are carrying a large surplus. It might have $100,000 or $200,000 surplus. But when talking to the campus, that's usually because they're building up a depreciation surplus to replace equipment. They might have a $200,000 surplus, but they have a $500,000 piece of equipment that's just about fully depreciated that they're going to have to replace at any time. So when you look at that, they're really in a deficit. So you really want to plan out the equipment. So obviously, you can't charge the full cost, acquisition cost of equipment a year, but you can charge the depreciation in your rate. So in doing that, you want to build up a surplus, an equipment surplus to replace that equipment. So when down the road that you'll have some funds to keep the service center running.
we actually go ahead and encourage them to buy the equipment and then start the depreciation on the actual assets so that the item is sitting there as a purchased item, knowing that it's going to now be in the rate going forward, so you know what you paid for it and it becomes part of the cost going forward. So you just do an off-cycle review to say, now we bought this, $8,000 item, add it to the rate, and it becomes a component of the cost going forward.
Any other questions before we move on?
Are you going? I presume you're going to be explaining how the FNA is incorporated into these rates, because you have an FNA that's part of the fee structure when it's created, but now we also have that service is built into some of our federal projects. So it's going to have an internal,
yep.
and then you have an external, and
Yep.
we're not double dipping on.
Yeah, Chris Rafalek's actually going to
Okay.
address the FNA items, so I don't want to steal her thunder, but that is coming up. Steal it? Oh, Chris, you're going to cover
Okay,
the-
yeah, and I don't want to get into too much detail on animal care, but there is a whole separate compliance requirement related to animal care facilities. So if you have animal care facilities at your campus, there's a whole NIH compliance document that describes, how you're supposed to go through that costing process, and talks about the direct cost of the animals and the related cost, direct cost, and then indirect costs related to that. So I don't want to get into too much detail, just so that if you have an animal care facility, there's a little bit more complicated requirements that we have to go through. Should we do raffle? Why don't we do a raffle?
Sure.
We gotta keep us honest here.
Winner is there.
Yes, will you be so kind?
Don Lavelle.
basket.
You ready? The right one.
Okay, so in the development of the FNA proposal, all campuses should identify their service center accounts. On the RF side, it's pretty easy to do because most of those accounts have the same award purpose code of service and facilities. But where we have difficulty identifying the service and facility accounts is on the SUNY side. So for example, especially in general administration, general institutional services, maintenance and operations, library, and student services for the long-form campuses. Those are the indirect cost functions of the FNA proposal. So for example, on SUNY side, a campus may have a central duplicating operation. In GIS, they'll have an account where they're recharging. If we don't remove that SUNY account from GIS, then the costs that remain in that pool will be picked up in the campus FNA rate. Okay? So that is why it's important to identify what are the SUNY accounts where the recharge activity is occurring in, and what is the related IFR account. Because as RF grants are charged, the income is placed into a SUNY IFR account, and those accounts also have to be scrubbed from the FNA proposal. Okay, I'm not that clear if that answered
No,
your
I think her question was completely different.
It was different?
Yeah.
Okay. But does everyone understand that? I mean, these are the critical functional areas of the FNA proposal. So all costs related to a service center activity needs to be scrubbed down, okay? So if you have anything left on the SUNY account in general administration or general institutional services or work orders or anything, you know, security sometimes is being recharged out, we need to reclassify those costs out of these pools and place them into other institutional activities in the FNA proposal. Otherwise, if we leave the cost in here and the service center account is in here, we could potentially be charging the government twice for the same cost.
Your question was, how do you incorporate indirect cost in your rate?
Right. Well, say they come up with their rate structure and they put a 15% on, so this service and facility account on any project that they have charges a 15%, it's embedded within. That service is now being included in a research project that we have, so it's a line item. So that 15% is already incorporated in. Do we exclude it from the base when we're calculating our FNA on the research project, or do we get it on top of, as if we contracted with any other vendor?
You shouldn't have it in your rate.
It shouldn't.
Yeah, as a general rule, you really shouldn't put that 15% in the service center rate. You should put you can put a cost in the rate, but so you do have a concern there that I think is valid, that you really shouldn't put 15% into the service center rate to begin with. Does that make sense?
Okay.
Because then to your point, then you charge it to a sponsor,
Yeah, right.
and then you hit it with indirects again.
Yeah, we don't include any indirect cost in our rate development for on-campus users.
Okay.
If you have,
If you're charging extra.
if you have if you have a specific cost, like you say, this is 10% of Joe Smith, or this is
Has to be specific.
5% of the supply. If you have a specific cost that you're talking about to include in the rate, that's fine. But just throwing a flat 15% is what's going to cause a problem.
You can't.
So I think if you have somebody doing like the billings for the service center or something like that, you want to include their salary in the
Their
rate,
time.
which you wouldn't normally be able to include in, you know, as a direct grant charge because it's an administrative
Right.
cost. You could do it, you could include that.
Okay.
But just a flat percentage is dangerous.
Yeah.
That's,
Yeah, it's really dangerous.
I'll make a note.
I knew your question as soon as you said it.
yeah.
Yeah.
Okay. Also, for
Yeah.
SUNY accounts, you need to identify the type of cost that is being recharged. Because sometimes you might be only recharging salary and wages that are in the account, for example, in GIS. So therefore, we would reclassify just the salary and wage costs. Sometimes you might be just charging materials and supplies. So then we would just reclassify those particular costs out of the indirect cost functions and place those costs into other institutional activity in the FNA proposal. Now, on equipment, SNF equipment. So our threshold and SUNY's threshold capitalization policy is $5,000 or more. So any piece of equipment where you are including the depreciation cost of that asset in your SNF rate, that asset has to be coded in the equipment inventory system, and that system is referred to, which is SUNY's system, as RAMI. And it needs a special code in that SVC/cost field, and the value of that that you would place in that field would be the letter S. So as we do the FNA proposal, we get a complete listing of the inventory system. We will look for that field and identify all of your service center assets that are included in the SNF rate and ensure that no depreciation is taken on those assets in the FNA proposal. Because if there is no code on there, we potentially will be depreciating that asset in the FNA proposal, and we'll have it in two places. You'll have it in your SNF rate, and we'll also be depreciating it in the FNA proposal. Now, on that particular code, that needs to be communicated to your property control office because they will not know which assets are included in an SNF rate. So as the rate is being developed and you are including depreciation, please, communicate that to your property control office. And as I mentioned, so all these costs then are reclassified from the overhead areas, and we place it in other institutional activities to ensure that there's no duplication of costs, to the feds. For long-form campuses, also SNF third-party recharge accounts are reclassified to other institutional services in the FNA proposal, and these are also pretty easily identified because they also have a special award purpose code in the system. If you haven't established your accounts correctly, then we would need to know which accounts are third-party, but pretty much we are relying on the coding in the system to reclassify these costs out. Now, sponsored research space in an SNF center. When we do the campus proposals for a long-form campus, so these are your university centers, ESF, College of Buffalo, upstate medical and downstate medical. We actually capture space in a facility and code it as research. So some of that space is eligible to be coded as research space. And we can do a space survey and capture that space, or we could use the campus billing records to determine what percentage of that room is being used for sponsored research. What we need to be careful about here is to ensure that you're not including any campus like utility costs or any space costs related to that space, because we are picking it up in the FNA proposal. Okay? And that's it. Questions and comments? Any questions on the FNA part of it, the impact?
Okay, thank you. So at this point, we wanted to just turn it over to Don and Sheila, and then I can also relate some of Mark's comments. But what are some of the challenges at the campuses? What are some things that work, some things that don't work? And we only have till 4:15.
Okay. I actually think what we have happening at Stony Brook is pretty effective in that we've centralized the rate development to an office, separate from my office or another entity on campus. So they are the entire campus functional rate developers, and they know what's required. And I will say that they're treated consistently between, whether it's an IFR recharge account or a service and facility account, the rate development is exactly the same. And if there's an attempt to, give a good deal to a campus user, we ask that they reflect the subsidy. So it becomes an actual direct charge to another account so that the account doesn't incur a deficit, so that the payment is made whole. Typically, that's just made in the rate development, so if the actual costs are a certain number and they don't want the rate to then ultimately be, say, $100 per service, and they'd like it to more be $80, we'll have them document in the rate development how they'll subsidize it to bring it down to $80, so that they'll infuse cash into the facility to give it a lower rate. And I think it works, and they do it every 2 years, and they're the same, whether it's an IFR or an SNF, and in many instances, they need both because the state won't pay research, so if it's an RF account and a state account holder wants to use the facility, they can't pay into it, so we end up with two. At the point of rate development, they combine both, and they're very effective. There's a team of two, like 2.5 people over in the accounting office that's all they do. They publish it on a large master list. I get the master list, and then I make it available to the people in my office when it's direct charging back to grants, and they can look up the service and they verify the rate, and it actually works very well. It really does. You know, there's a point in time where they go to check it, and if it doesn't match, we'll stop the bill. We don't pay the bill, and we, you know, redirect it. And sometimes it's just a matter of timing when the rate was being worked on, or it was an old rate. But you know, you can go back and find the old rate. But I think it works very well.
That's what we
That's it.
aspire. And
Yeah.
that's what we aspire to. Between yours and UB's that I think Chris is going to talk about in a minute, we've modeled a lot of our changes that we've been going through over the last year on your procedures and policies and UB's, and I can tell you that for those of you who haven't been visited, the auditors are out there and they are
Yeah.
looking at this stuff. So
As a matter of fact, we're doing a desk audit right now, which is extremely painful, with Sandia Lab, which is a DOE flow-through. There's a small charge for, it's under $1,000 for a recharge for tank gas service. So we have a unit on campus that does this for safety reasons. So they bring in the items that are necessary for the various labs around the campus, and they have their rate is to charge back cost plus a percentage, which I think is like 40%. So all invoices are marked up and they're returned and paid for, you know, let's say this bill is $950, and they want me to go back, and I'm doing it because I don't have a choice, to the invoices from the service center for those things that were brought on campus to show that the base costs were whatever they were and that the ultimate bill was only 40% more. So if you think you can just do it and not show it, I'm here to tell you it's not where you want to go. We wouldn't let them anyway. You know, it just, you know, it has to be break even and it has to support the costs that are in the account. If they put together a rate and they say there's an individual being charged and we look at the account and the person is not actually being charged, we require that they back the person out of the rate or move the person into the account. It can't just be, yeah, they're over there doing this.
So the 40% in your case as opposed to the 15% in this case, the 40% is markup is based on
The
actual.
cost to provide the service, rather than
Okay.
saying it's 2 hours of someone's time, it's a service unit that provides delivery of gas and safety elements in the delivery of gas to the various labs, and it was determined that the cost per person is a annual, you know, 40% markup to the base cost from the vendor, and it's annualized, you know, every
So
year.
it's paying for the people who support that.
Who actually do the work.
Yeah.
Go out and drive the trucks and deliver and recover the tanks and, you know, yeah.
So they have some historical data
Yes.
that backs up that
Yes,
40%
what it
that they're
takes to do
charging.
it, yeah.
Yes, the only other things that I can say is, you know, we've had the same issues with the, you know, having the IFR and SNFs. We have a couple of units that are doing that, and trying to get them to, you know, pull everything together can be a challenge. We've made some changes to our procedures as a result of an internal audit, and we're actually now, the provost and our chief financial officer, who's our vice president for administration, and also our research foundation operations manager, both sign off on
The
the
rates.
rates. And part of that is because of the subsidy fact that these things are very heavily subsidized in these days when budgets are very tight. They're looking for situations where, you know, maybe we want to recover a portion of that person's, that state employee's time that is being subsidized
Right.
here. And so they may, and you know, it hasn't happened yet, but they may decide to enforce those types of things. The other reason the provost really wants to be involved is he's concerned about access to the equipment that has been purchased for these units, and I don't know that there's any evidence that this has necessarily been happening, but sometimes that equipment was purchased partially with the thought that it would be used for instructional purposes, and if it's then being used for, you know, solely to generate revenue for the service center as opposed to pulling in the instructional portion of the campus's mission, then he has a problem with that. So I think that's about all I have to say.
The one difficulty I'm having right now is when a new facility requests to be established, so you have someone designing a new plan and they want to put together a new facility, we have a document that goes to them. It's pretty basic and just says, who will be responsible, what's the organizational unit on campus, what's the intended purpose, sort of a business plan. And I have a statement on there that says, and so the chair has to sign, and it says that by signature, he or she accepts responsibility for any deficits that should result in like now the unit's no longer operating and there's a $10,000 deficit, they're responsible for that deficit, and they're struggling with, taking responsibility for that, but they can't establish an account without that statement, IFR or SNF. We treat them the same, so.
Yes.
Yeah, and as far as UB is concerned, I think UB is struggling with similar issues. The one thing that Mark did say is, the biggest challenge is convincing the PIs and other faculty that the approval process is necessary. So, relatively speaking, they, want to set something up and they want to start charging people, without the realization that, this is a serious compliance issue, and there are hoops that need to be jumped through in order to set these things up, and there's controls that need to be in place. You can't just willy-nilly just start recharging users. So that is apparently a challenge, at UB, in addition to just the fact that these rates need to be reviewed, every 2 years, the rates need to be reviewed. But Mark also, as probably all of you are, there's kind of a struggle for resources to do this kind of thing. So there's not, people who are dedicated to doing this. It's kind of all other duties as assigned. And it would have, in a perfect world, it would be nice to have, a dedicated staff who do this thing and have the time to do it. But at UB, I think similar to maybe what you're implementing now, both at your schools, they now have the CFO now needs to sign off on new rates, and that they do have a rotating schedule of reviewing rates every 2 years. So, and I think Dave mentioned, right, they have a nice policy and procedure that they have posted. I believe they also post rates on their website so everybody can see what the going rate is for a lab test or what have you. So, I think UB is similar to everybody, that they're trying. There's some challenges and there's some risks, but
It's actually been very effective. What I've taken the list of all recharge centers on the campus and sort of created a master list of those that will likely recharge an account through the ERF. And what happens is when the grant specialist approves the transaction at the payment time, if the rate doesn't exist on the file, it doesn't get paid. And so if they attempt to recover for something where there hasn't been a rate, it stops in its tracks, and it's actually really effective, because then you have to go through the process or figure out another way to get your costs recovered. So it's actually taking care of a lot of that, being able to just blindly charge for things and say, I think it's like $50. It's actually worked. So.
Is there any other questions? Yes.
We have a group on campus that set up a new service and facility account, and they would like to keep the members of their department. They would get offered for free to those members of the department. Obviously, they would need to be part of the rate calculation, those uses. But have you had that on your campuses at all? Or do you have any kind of advice about what to be specifically mindful of in that situation?
So we would make them we would require that they document that as a subsidy. And they would have to create an estimate that said, we expect our campus, our departmental users, there's 5 of them, and they would need access to it for, a certain amount of time. And so whatever that value is as an estimate, to quantify it in a dollar amount and then provide a subsidy, so that when those come through, they won't produce bills for them. But they're responsible for keeping track of how many people use that, and isn't it reasonable and break even at the end of the rate period.
Right. That
Because
way, that way you can keep.
the issue there is if you're giving internal users a break, there's a pretty high risk that you're overcharging the federal government,
Yeah.
right? That's what the issue is.
Yeah.
So like to Sheila's point, somebody's got to pay for it, right?
You have to show it as revenue on paper at
Right.
the very
Right.
least, and
Right.
as an expense on paper.
Right.
That's,
Right.
Right.
even if it isn't.
Is there any other questions? Okay, well, if you do have anything, after this, and you give us a call or shoot us an email, or, we'll be happy to work through this because, in our environment, this can get to be, sometimes what are, simple concepts get very complicated in practice, so.
I will say kudos to these guys, because whenever you ask them a question,
Yeah.
they're very good about getting back to you, so.
Yeah, they're great. They know the answers.
Okay, thank you very much.
Thank you.
Thank you.